Hello, my name is Oliver Madden, Director, Securities Lending at IHS Markit. I am delighted to be joined today by Kevin Bourne, Managing Director and Head of Sustainable Finance at IHS Markit, to talk about the evolving world of ESG data and what it means for securities lending. Prior to joining IHS Markit, Kevin held executive positions at Citibank, HSBC, and FTSE Russell, where he was Head of Sustainable Investment. Kevin, welcome to the Securities Lending for Institutional Investors podcast.
Thank you, Oliver. Pleasure to be here.
So for asset managers and asset owners globally, there is arguably nothing that is higher in priority right now than ESG. Many commentators expect 2021 to be a year where ESG disclosure and reporting will become a major feature. I saw a quote in an ESG Clarity article at the start of this year attributed to Kurt Custard, the CIO of Newton Investment Management, where he said 2020 was an educational year where investors learned why ESG is important. 2021 will be more about the nitty-gritty and putting ESG into practice. So I thought that was a good preface as we lead into a conversation around ESG and ESG data. So let's start with where we are right now. What's your view, Kevin, on regulation on ESG ratings, both as is being currently discussed in the EU and elsewhere in the world, and what ESG-related trends and regulatory developments are on the agenda this year?
Well, thank you, Oliver. It was interesting to hear you quote Kurt, who I know, and I agree. 2020 was an educational year. In fact, I think we've had 15 or maybe even 20 educational years on ESG and climate change. And now we are reaching a point where decisions are being made over the future of these disciplines that step outside of what we have become used to. There's been very little compulsion in ESG or climate modeling or reporting over the last 15 years. What is a relatively nascent data science has become more sophisticated, more detailed, and as we're all aware, more complicated. I think with an understanding of the risks we now face, the one thing we are going to see this year, to agree with Kurt and to agree with a lot of commentaries, we're going to see much more regulation. And there has been an increase, a step change in regulation over the last 10 years. The London School of Economics, Sam Fankhauser, Nick Stern and the team there have been tracking the implementation of regulation across sustainable finance and across sustainability. And it's interesting since 2018 that the number of regulations impacting markets have increased very significantly. And probably the fastest growth area in regulation seems to be regulation for climate and ESG around markets. That's happening at different speeds in different parts of the world. Clearly, in the US, it was slowed down to a large degree with the last presidency. That's now changing very, very quickly. The EU has carved a very strong path in ESG regulation, but I think it is important when you're looking at what individual countries are doing is to understand whether they're regulating ESG or whether they're regulating climate risk. The two are the same but different. Climate risk is a very narrow component within ESG as an overall subject. If you had 50 sub-themes in an ESG model, climate might be directly only 2 of them. But it is the systemic risk of climate change that is driving, I think, and going to continue to drive much of the regulation that all countries apply. Whether some countries apply S&G with equal veracity remains to be seen. So the change is coming, and it's coming reasonably quickly now.
I mean, how far do you think we are that ESG will travel, as a process, both regulated or not? I mean, how do these themes affect, and then how do these themes affect demands for data?
Yeah, again, ESG has been a part of our industry probably as long as the industry's there. We just didn't call it ESG. I think all good fund managers always looked at any investment they were going to make, and they looked for information and issues beyond the balance sheet, beyond the numbers. That's the role of a good fund manager. I think what we've done in the last 10 years is codify what was an inherent process for most fund managers anyway. That codification has happened at 2 levels. Firstly, it tends to have happened with larger companies, mainly because they've had the resources to respond to the requests they're getting for information. Secondly, it's happened with equities rather than with debt instruments, although debt instrument and sovereign ESG are very much accelerating now. The bulk of the research and the bulk of the information has been based off of companies and equities. And also, not all equities. There's clearly been an economic approach to this where the vendors, all of the vendors, have been able to work with larger companies, extract the information that's been reported, and they've been able to commercially take that into the marketplace. Part of the challenge, of course, is just the resources required to complete these information frameworks that the companies are asked to complete. I would not want to be a large company or even a small company at the moment trying to understand what I would do over ESG reporting. There are at least 100 that we are aware of ESG reporting frameworks of varying shapes and sizes, of which 15 or so seem to lead the field. So if you are a public company or a private company who are increasingly involved in reporting, the first question you have to tackle is which framework do you report against? I know from research that we've looked at, if you take the leading 14 frameworks where there are nearly 10,000 separate ESG questions, only 500 of those have a direct mapping, almost a word-for-word mapping. So there's a lot of minor differentiation in ESG questions that get asked. So if you're the CFO, you've got to decide, or the head of sustainability for a company, and you're going to decide what you're going to report, how do you even begin to decide which of these frameworks you use? So the issue, one of the big issues I think we're going to tackle over the next 24, 36 months is how do we end up with 1 or 2 global reporting models rather than the 14, 15 plus? Because with regulation, what I'm seeing is that the regulators themselves are then publishing their own ESG schemas and frameworks. And we've got 14 leading frameworks from vendors, from NGOs and supranationals. Are we likely to see another 20 or 30 from different countries? Clearly, that's not sustainable. It's not sustainable for the corporates, and it's not sustainable for the vendors that have to, and the market participants that have to collect and normalize this information.
You're hearing quite a lot of sort of challenges and pressures for institutional investors. I mean, how do the ESG related pressures facing them impact risk and returns?
Well, I think one of the greatest challenges when you're measuring risk and return is what part of the ESG spectrum you're going to measure risk and return on. You find ESG data models now, just for companies, might have in excess of 1,000 individual data points they collect. There's a large range of structures that are used to collect those data points, from Boolean answers to written paragraphs. There are all sorts of unintended outcomes from the way the data is collected, all sorts of bias added into the data and the analysis of that data. So I think if you're looking at risk and return, and from the base data, the ability to capture meaningful signals, you have to be very careful in what you ascribe to the information and its properties. If you do an attribution analysis on many of the underlying ESG data points or sub-themes, it's very, very difficult to genuinely attribute a particular event to a change in the company's risk-return profile. Now, I've read some studies that say you can. I've read many more that say you can't. I'm not a quant, but I do have lots of friends that are quants in various hedge funds and pension schemes and banks. They're all saying the greatest challenge is looking at these data models and deciding where they genuinely provide meaningful signals. Now, that doesn't mean that the data isn't important. It doesn't mean with good curation that the data can't help inform investment and risk decisions. But I think we have to accept that some of the risk decisions particularly are not based on strong signals evidence, but they're based on the application of operational metrics, where we are deciding that we should not be doing things because they are bad. That is not a signal, that is just common sense. And therefore, ESG from a risk and return point of view, I think, is very much predicated on which data points or set of data points you're working with, and specifically what it is you're trying to achieve with that information.
So how can managers get ahead of the market when it comes to responsible investment?
So if I was running money, I think you've got no choice almost today but to think about ESG. The greatest challenge perhaps is how do you use ESG data to differentiate your core investment beliefs? So if you are running a small cap Asian portfolio and you believe that your core investment strategy differentiates you from your peers and you're responding to investment mandates and speaking to clients, the challenge now is how do you use ESG to reinforce your existing investment philosophy, your existing investment policies and structures? ESG in isolation, should it be a core investment philosophy? That's for the fund managers to decide, not for me. Should it be built into your investment policies? Yes. Certainly there appears to be a lot more focus now, certainly from the larger fund managers or some of the specialist ones, not to use ratings, not to use vanilla ratings just to provide an overlay. They're saying the ESG information that is available, how do we use it? And increasingly, how do we build our own ESG models? It's a little bit, almost a bit like the change that happened with fundamental factors after Rob Arnott's work many years ago, and the widespread acceptance of fundamental factors into the investment process. What then happened after everyone started using some fairly simple fundamental factor models, the more sophisticated investors then started saying, how do we, rather than just use these vanilla fundamental factors, how do we optimize them into our portfolios? And how do we use that to really differentiate with good data science and good mathematical science where we think there is additional value that can be gleaned? I see ESG, or certainly a lot of the ESG components, going down the same path, whereas the data sets become more sophisticated and their efficacy levels rise, transparency of the underlying data becomes more readily available commercially. But I think fund managers, banks are going to be looking at this data and saying, we're not going to use ABC's ratings. We're going to have our own ratings as we have our own fundamental factor models, because we want to differentiate our view. The nuances in the information must be our nuances based on our investment objectives.
Yeah, thank you. So, I mean, from listening to you, it's pretty clear that the pool, the data set, the available data, the required data is just going to be becoming quite significant. So it sounds to me like there's a role, there has to be a role for technology in addressing these challenges.
I don't see how you can collect and manage this data without technology. And just to add an important point, I think we're only at the start of the scale of data we are going to collect, because the regulations are going to take us down that route. The EU, I think, has already set that rabbit off. At the moment, we tend to, because of the history of ESG, where it's come from, we tend to think of ESG data being aligned with companies, and as I said, increasingly with sovereigns. But there's been a lot of work done on ESG data linked to properties, environmental certification around properties, and increasingly infrastructure. It's been made quite clear by the regulators that they regard ESG, but particularly, as I mentioned earlier, climate risk assessment, as being all legal entities, all asset classes. Now, please get on with it, financial markets industry. That's an easy thing to say, but it's a very difficult thing to do. You know, how do you set an ESG criteria for a bridge or an airport or a ship? You know, these are all assets that fall into investment portfolios at different levels. When you're looking at a company, yes, but how do you look beyond the company's core operating model? How do you look down through its supply chain, through its operational footprint on a multi-jurisdictional basis? So the amount of data and the sophistication of data is only going to increase. We're at the bottom of the S curve. We're not even halfway up with the data collection journey. We have to do three things. Number one, we have to decide what we're going to collect. Then we have to decide how we're going to collect it and how we ensure that the data we are collecting within acceptable business practices meets our criteria, and then how we're going to apply that information and what it's going to inform us once we've actually collected it. So at the moment, I think ESG data is probably restricted to between 8,000 and 10,000 public companies. Well, what about the other 50 or 60,000 that could be in an investable universe, maybe 20,000 at least in an investable universe? What do we do about private companies? And as I said, what do we do about all these other instruments and asset classes? So technology, yes, we've using AI and NLP will obviously increase. I'm a little bit cautious about some of the claims being made about how good AI and NLP are. They're very helpful. Looking at what has to be done, I think AI and NLP are a significant contribution to the data collection cycle, but they are not the data collection cycle. You still have to apply human analytical skills. You do not have AI that is as smart as people yet. Maybe when we do have other issues, we're debating rather than collecting data.
You've mentioned a few of them, but I mean, who are the key actors in the ESG data process?
For me, there are really 4 levels of engagement. And let's not include the companies that have to actually use the frameworks and issue the data. So for me, the first level that's been there almost since the inception are the framework providers that say to the companies, this is our framework, this is the one you should be filling in. As I said, there's a large group of them. And the companies are either using 1 or 2 or a combination of them to put their information into the public domain. So the first group of players are the NGOs and supranationals who provide these frameworks for ESG data reporting. The second level has very much been the vendors who've collected this information, they've normalized it, they've made it usable for markets participants, and then that obviously goes out to the buy side, the sell side, the investment consultants around the world on a commercial basis. Then you have the people who consume this information, the institutions themselves. They've very much been part of the cycle because they'll obviously take this data and modify it. They won't use it. They may use it as it comes out of the tin, but increasingly they're modifying that and applying their own additional data in their own internal analytical cycles. But now the fourth, and to me the most significant player, has got to be the regulators. In the regulators, I'll include the international standard setters like the IASB, the International Accounting Standards Board, which has quasi regulatory type overtones for its work in the way it sets the standard for financial reporting. And obviously they're looking very much at non-financial reporting standards. And wouldn't it be great if we just had a couple of non-financial reporting standards globally rather than the plethora that currently exists?
Thanks, Kevin. So I mean, we've spent so far just talking, setting sort of the fantastically the environment, the broader context within which and the challenges with which asset managers and asset owners are kind of having to address right now. Let's turn and talk about sort of the securities lending side of this, and if there is one, is probably the first question. So, do you think what we've just spoken about, will it impact securities lending?
I think it impacts securities lending at 2 levels. The first level, as an equities trader of many years, I'd want to know if I'm looking to borrow and to short a company. I'd want to know what its ESG metrics are, and I'd want to understand if ESG is providing, understanding what I said earlier about which bits of ESG you look at, if there are any value signals in ESG that could impact my desire to borrow and to short a company. Now, ESG data tends to fall into 2 very discrete buckets. One is what is known as slow ESG, so historical ESG metrics published by the company, available in the public domain in various levels, scraped by vendors, built into ratings and metrics. And the other is fast ESG, so looking at news flow and news stories, codifying that and applying that against ESG focused criteria. The latter, we've always done it, but we just haven't called it ESG. I think of initiatives from the major news vendors many years ago to codify their stories, not just on ESG related issues, but on all issues, so they could be fed into the tick engines that the algos were using, both buy side and sell side, to inform intraday trading activities. So all we're doing really is taking a practice that's already understood and just making it much more subject specific around ESG data points and metrics. but should ESG logically fit in to the stop borrow process? Absolutely, without any doubt. And I would like to hope that anyone who's thinking of borrowing securities is also looking at the ESG profile of the securities they are looking to borrow. It should be, for me, it should be a hand-in-hand process. Why would you not do it? Any additional information that could inform a decision over whether a borrower is appropriate, whether the price for that borrower is appropriate, must only help the borrower and the person lending over how they set the cost of the borrower.
Yeah, no, I think you're right. I mean, you've got the inherent signals, as you've just touched on, within the securities lending data and what that might be used by managers, certainly those that have the ability to short sell. And if you accept that, if not already, then certainly over time, those companies with a focus on ESG and responsible investment and sustainability will outperform those that don't, then then it's a natural step to say that you're gonna short sellers will short, that use short selling as part of their more broader strategies, might go short those sort of companies and long those that are more proactive and advanced in their adoption of those.
An interesting aspect, isn't it a healthy thing for the market where the risk of being shorted because you've got poor ESG will help put pressure on management to resolve these issues, some of which persist a lot longer than they should do because they're well within the gift of these management teams to resolve them. Yeah,
no, absolutely. And then the second area is more just from a program management perspective. I mean, securities lending always is I always see securities lending as something that adapts to the core investment management activity and policies of an asset manager and asset owner. So by definition, the more in which institutional investors are embracing, adopting, changing their own organizations to integrate the factors and the things that we've been talking about today, that has to cascade down into their program parameters and the way their program is managed. And that's something which I know that their lenders will be equally attuned to, and just as a general point for our viewers today is, the more in which your own organizations are making those changes, as we've discussed, speak with your lending agents, because they will be absolutely aware of that and they will work with you to accommodate your requirements within the way in which they manage your lending activity. What do we just end with one final topic around here, which is this: is there a possibility, certainly for those that are familiar with, say, SFDR, there's this concept of a principal adverse impact. I mean, in your opinion, is there a possibility that securities lending will be considered a principal adverse impact?
Well, the three headline regulators in Europe have just provided their submission back to the EU for the level 2 disclosures. And this was not a big issue within the whole process. Now, you get into a really interesting philosophical question over whether you do or don't support stock borrow, and I think that's very much down to the individual institutions to decide where they sit on that curve. So whether the issue of borrowing securities to short a company ever become a adverse impact as a legal definition will be a challenge, I think, for the industry, certainly within the EU, to manage over the next 2, 3, 4, 5 years, because there are certainly a group of actors in the market that would say it should be, and there's equally a group of actors that say it should not be. I'm not going to pass an opinion over which way it will go. The regulations will end up where they are. But I've no doubt that the consideration that fund managers must have under the SFDR, where they look at the ESG criteria of their own business, not the funds they run, but in the first instance, the level 1 criteria coming into effect on the 10th of March this year is about how you run your business, about how you engage and what your investment policy is as a financial markets participant. Then I think it'll be interesting to see if anybody raises this in their responses that will all be published online. Perhaps the regulators will get involved in this debate, and it remains to be seen. But I think at the moment, it is not a core part of adverse impact, and only time will tell if it does become so.
Kevin, thank you. I mean, just picking up on one of the things you said a few minutes back, I think we're kind of at the foothills of this topic, and it's going to be fascinating to see how things evolve this year and beyond. So, thank you so much for your time. I'm pretty sure I'll invite you, and hopefully you'll kindly accept to come back again in the future with a bit of an update on where we are. But for today, thank you very much.
Well, it's been a real pleasure. Thank you for inviting me.